Optimism on trade has stocks moving higher. The question is, how excited can we really get about a potential trade deal on that encouraging sentiment we did hear yesterday from President Trump? Joining us to talk all things markets is Courtney Dominguez, Senior Wealth Advisor at Payne Capital Management. Hi, Courtney.
Thanks for having me.
Thanks for coming back on. You got your giant iPad. Ready to go. What are you seeing right now? What are you seeing today? And then if we largely look at this week, there has been some positive movement, but a lot of it, it's the same old story where, we see one great comment that says, we're close to a deal, or China's willing to come to the table, and everyone, I think, kind of overreacts one way or the other.
Oh, very much so. And I think when you actually look at how the economy has been doing all year, we're continuing to see some really solid data. It's just this nervousness with trade fears. That's what people are really trading on right now. So the second it looks like it's not going to get figured out, the markets trade lower. The second it looks like it is, markets trading higher. But none of this is actually changing all the underlying fundamental data. And regardless, the economy is in a good place. So if there's any dips, it's just something for people to take advantage of more than anything.
Go ahead. No. Well, then I was going to say, Courtney, this yield curve inversion that everyone's been screaming about, in your mind, right, it's just a short-term phenomenon that's essentially been precipitated by the U.S.-China trade talks and not necessarily about the fact that we are seeing fundamentals in the economy that indicates a recession.
Yeah, I mean, to start off, you can never look at just one single indicator. So yes, that has preceded a lot of recessions in the past, but it's also a really poor timing tool when it comes to the markets, because out of the last four out of the last 6 times that the yield curve is inverted, the markets have actually traded higher a year later by an average of 9%. So when you hear, the yield curve inverts and people panic, that does not mean something's going to happen today or tomorrow. And there have actually been times where no recession has preceded the inverted yield curve. So I don't think it's something to really trade on immediately. It's also only one indicator, and there's many others that are positive right now.
Courtney, when we look at this month, it was a roller coaster for stocks, right? All the major indices are essentially lower on the month, and we see safe haven assets like gold up 8% or so this month as well. So if you're an investor and you want to put fresh money to work, right, where do you put this money? Do you put it in these safety trades, the bond proxies like the utilities, or do you put it into more of the growth names?
Or Bitcoin.
Right. Bitcoin. Yeah, and that's what's been happening is everybody's so nervous about the markets. You're actually seeing investors pouring money into bonds right now, which doesn't make a lot of sense considering bond yields are so low right now. So I definitely think equities are the place to put money to work if you have new money right now. Because they actually get better dividends than bonds do right now, and you have that growth potential. But I actually say rather than growth names, I think your value companies are actually trading much lower than their historical averages. So I would say your growth companies and also your foreign companies, with all the talk of trade wars and tariffs, those are also trading lower than their historical averages. So I would say those are probably a better value right now.
When we talk about the positive indicators in the economy and everyone maybe is overreacting about recession fears, health of the U.S. consumer very good in the most recent data.
Yeah.
It does look like we're setting up for a extremely significant, important holiday shopping season because we've heard so much about how, for all the talk of tariffs, it isn't yet the case that they're hitting consumers' wallets, but that might happen soon. That might happen soon. I mean, how pivotal are, November and December going to be in terms of proving out whether things are actually still pretty good?
It's definitely something we're going to be watching. So I always hear of that Santa Claus rally where as consumers are spending, that really can boost the economy at the end of the year. And all of the data that's coming out, and specifically on retail, and their forward guidance is showing that the consumer is really strong. They're expecting them to continue to be strong going forward. Consumers are actually spending more money, but also saving more money, which means they're not have a lot of debt right now. Going into the holiday season, that's a very good sign. And that does translate really well into a good economy, considering the consumer is 70% of the U.S. GDP. So as we see that going forward, I do see that as a positive
What do you
impact.
predict for the jobs report that we're going to get next week? What are you looking at?
I wish I had a crystal ball and I could really tell you here.
Numbers.
But I mean, we've continued to see strong data. I don't really see or hope not to see any signs of that weakening. But so far, it's been a strong year, and I would hope that we see the same thing going forward.
So question for you on the Fed. Obviously, it seems to be a foregone conclusion that we're going to get rate cuts. Do you think the Fed is going to become a lot more accommodating, get more in line with what we're seeing from the central banks in Europe? Or because they're under a lot of pressure right now from the president and from investors alike?
Which is interesting because a lot of the reason that they have lowering interest rates is all of the uncertainty with trade wars. So if this gets figured out, I don't know if they're going to have to cut as much as they have in the past or as much as they're saying that they need to. Because all the underlying data, which is more of a reason why they should cut rates, is perfectly fine right now. So it really depends on how trade wars get figured out. I think that's going to be more indicative of what the Fed's going to do in the future.